Alright, so because of popular request, I'm going to take a look at Facebook's recent results. Let's do a deep analysis into it and what it means for investors. At the same time, I'll also take a look at Alphabet's recent results and its decision to do a 20-for-1 stock split, and again, what it means for investors. So let's begin with Facebook, now known as Meta Platforms. And so they just announced their earnings results yesterday, and the market kind of like freaked out based on the after hours price performance. So if you want to take a look at the after hours, let's take a quick look. So before the earnings, you can see the stock has been on a very nice uptrend. And of course, it went through a retracement like all the other tech stocks, but found support at the $291 price level over there. So this was a strong level of support, and boom, earnings came out and people freaked out. Or not really people, I would say the algorithms, right? Remember, 80% of buying and selling are not driven by human beings that make fundamental decisions. They're driven by algorithmic machines, okay? And that's why in the short term, remember, the market tends to overreact to bad news and overreact to good news. And so stocks get mispriced from the value of the underlying business because of that. And as investors, you have to learn how to take advantage of that by understanding what's the true value of the business and to know when the price is irrationally cheap or irrationally expensive. So with that, let's take a look at Facebook. Now, let's take a look at the after hours price. And you can see the one in gray is the after hours price. So after hours, after results were announced, after the market closed yesterday, boom, you had this big red candle down. We are looking at the 5-minute candle, all right? And we have been having a slight recovery in the last couple of minutes. So we'll see how it goes. But as of now, it looks like Facebook, if it opens according to its after hours price, it may open at $260 per share. So that represents almost a 20% drop from its closing price yesterday. Let's look at the charts over there. So $260, it looks like it's gonna gap down to this support level over here. There's another strong support at 253 and another very strong support at 231. So the question is, what caused the market to freak out? Let's take a look at the earnings report. So FB reported earnings per share of $3.67, which was below expectation. The expectation from analysts was $3.84 per share. And $3.67 is 5% below the same quarter last year. How about revenue? Now, revenue came in at $33.67 billion, which is up 20% based on last year's same quarter. And it's higher than expected. So revenue came in slightly higher than expected, which was 33.4 million. All right. Facebook's daily active users. Now, it has been reported in the news that it's the first time their daily active users have fallen from the previous quarter. All right. But year on year, it still grew 5%, from 1.93 billion active users to 1.95 billion active users. Their monthly active users grew by 9% year on year. Average revenue per user rose from $11.57 to $11.38. Now, the other thing that freaked the market out was that Facebook lowered its forward forecast for 2022, the first quarter, right? So a lot of analysts were expecting that for the first quarter of 2022, they're going to do 30 billion of revenue for the first quarter, but they said because of some challenges in competition, they expect to do 27 to 29 billion dollars instead. So basically, there are three things that are freaking the market out and causing the 20% drop in the share price. Number one, they reported a drop in profits from the previous quarter. So that's one thing that's freaking people out. Number two, their forward guidance is lower than expected. So based on this forward guidance, they're expected to grow revenue at between 3 to 11% for this first quarter, right? The third thing is the first time their daily active users have fallen on a quarter-to-quarter basis. So that is what's freaking out the market. Now, As an investor, should you get freaked out? One of the things that I've learned in investing and in life is don't get over fixated and don't get overly concerned with short-term results. All right? Because, even great companies have good quarters and bad quarters, and even good years and bad years. So you have to take a look at the bigger picture. How are they performing over a longer time frame? It's kind of like getting upset that you're having a pimple and thinking that because I've got a pimple, I'm now a very ugly person, right? So again, like I said, don't get too fixated by short term. Look at the longer term. Is the business competitive advantage intact? Is it still growing? And what are the shares worth? So let's take a look at the bigger picture. So over here, you can see that year on year, or quarter on quarter, right? So this is the last quarter of 2021. Again, look at revenue. Revenue went from 28 billion to 33 billion. So that's a 20% growth in revenue for the quarter. Not bad, right? Now, for the entire financial year, it grew 85 billion to 117 billion, 37% revenue growth. So if a business is growing at 37%, is that bad? That's pretty good, right? 37% revenue growth. Okay, fine. How about profits? Let's take a look at profits. Now, profits will be net income. On a quarter-to-quarter basis, it fell, right? It fell from 11 billion to 10 billion. So negative 8% drop in net profit. But that's just one quarter. How about the whole year? Look at the whole year, right? And for the year, it went up 29 billion to 39 billion. So profits went up 35% year on year. So revenue is up 37%, net profit is up 35%, but most important is free cash flow. What's the growth or the decline in free cash flow in the last 12 months? So if you take a look at the numbers, you can see that for the financial year ended 2020, free cash flow was $23 billion. And the last 12 months is $39 billion. So if you do the math, this represents an increase in free cash flow of 65.5%. So again, a company increasing their free cash flow at 65.5% is a pretty darn good business. So what about the concern about falling profits? Why is the profits falling if the revenue is going up? So let's take a closer look at where that is coming from. Now again, over here you can see the breakdown in revenue from its family of apps. So family of apps would be its legacy businesses, right? Facebook, Instagram, Messenger, and WhatsApp. These are its legacy businesses. Its new business is developing VR and AR for the metaverse, which is its new business that's not yet profitable. That's called the Reality Labs part of their business. So if you take a look at their revenue, you can see that it's been growing year on year. So their family of apps growing at 70 billion, 84 billion, and 115 billion. So their legacy businesses have been growing. All right. Their AR and VR, the metaverse, has been growing at 500 million, 1 billion, and 2 billion. So their metaverse business has been doubling year after year for the last 3 years. Now, if you look at it from a quarterly basis, same thing, you can see quarterly it's been growing. Legacy business growing to 32 billion, and its Reality Labs business, the metaverse business, has also been growing on a quarter-to-quarter basis, right? So overall revenue, you can see has been growing 26 billion, 29 billion, 29 billion, 33 billion. So revenue is growing, right? So that's not a concern. Profits. Now, the legacy business, profits have been growing. Look at their income from their legacy businesses. 14 billion, 13 billion. So there was a drop for this quarter, then up to 14.8 billion, went up again, dropped to 13 billion and up to 15.8 billion. So again, it goes through ups and downs, but overall the trend is their legacy businesses are getting more and more profitable, right? But their Reality Labs is what's losing more and more money. In other words, their new metaverse business, right? Losing $1 billion, losing $2 billion, losing $2.6 billion, losing $3 billion. Why? Because again, this is a new business that they are spending more and more money on, and it's not yet profitable. It may take 5 years to become profitable. So in the meantime, they have to take that hit. It's the same thing as Disney. Why has Disney's profits been dropping the last couple of quarters? Because it's been investing heavily in Disney Plus that's not yet profitable. So you kind of like have to take the short-term pain to get a long-term gain. That's what happened to Amazon as well. There was a time when Amazon's profits dropped a lot because they were investing heavily in their cloud business. But once their cloud business became profitable, it increased the entire profitability of the entire group. So I'm not too concerned about the drop in profits for Meta, because the drop in profits is because of its new metaverse business that it is heavily investing in, that it's not yet borne the fruits of the investments. And that will take a couple of years. But in the meantime, yes, profits may go down in the short term. But if you're a long-term investor, it's something that I don't think I'm too concerned about. Now, what's the other concern? The other concern is that their growth is slowing because people are spending less time on Facebook, Instagram, and people are spending more time on TikTok and so on and so forth. So is that a concern? Yeah, it could be a concern that their growth is slowing down. Their daily active users, although year on year is growing, but it's growing at a lower rate. So yes, their growth is slowing. That is a concern. All right. So as an investor, the question is, after the shares have fallen in price, is it still a good deal? Or is it no longer a good deal? So that's where we have to look at valuation. That's where we have to do a discounted free cash flow valuation of the business. So what are FB's shares really worth? Well, it all depends on your growth assumptions. So again, bear in mind that currently FB's revenue is growing at 37%. Their net profit, net income is growing at 35% year on year. And their free cash flow has grown at 65.5% year on year. But like I said, do we expect it to continue growing at this rate? No. We expect the growth to slow down because it's getting saturated. There's competition from TikTok and Snapchat. There's the Apple privacy changes that's going to slow their growth down. So we have to, take that into account, right? Okay. So what kind of growth rate do we use? Now, currently, their free cash flow is at $35 billion. They have got zero debt. So that's what I love about this business. When a company has no debt, there's no worries, right? They've got $48 billion in cash, which they've been using to buy back shares. So is it good for a company to buy back shares? Yes, very good. Because when a company's shares are undervalued and the company buys back shares, that reduces the number of shares in circulation. So with less shares, that means each share is worth more and more. So simply by FB buying back shares, it increases the intrinsic value per share. Anyway, so that aside, what growth rate should we use? So as you can see on my valuation calculator, I've got 3 growth rates for the first 5 years, for the next 5 years, right? This year 1 to year 5, year 6 to 10, and the last 10 years. Right? So what growth rates do I use? Now again, we're not going to use these growth rates. We're going to slow it down, right? And if you take a look at the various websites, they have growth projections. So for example, on Finviz, they are projecting a 21% growth, Zacks 19% growth, Simply Wall Street 11% growth, and Capital IQ 18% growth. So different websites have different analyst consensus. They've got different projections. So if you take an average of all the analyst consensus, you get a growth rate of 17.8% for the next 5 years. So if I put that into my calculator, 17.81%, right? And I then assume that the next 5 years, the growth will slow down even further by half because it slows down, right, to 8.9%. And for the last 10 years, I assume that FB is only going to grow at 4%, which is the GDP growth rate of the US economy plus 1%, right? So based on this assumption, FB shares are worth $403. And as of yesterday's after hours price of $250, FB is now at a 38% discount to valuation. Now, what if we get even more pessimistic and we are saying, hey, I don't think they can even do 17%. So let's take the lowest projection, which is 11.7% on Simply Wall Street. So that's really, really low. I mean, think about it. They are now growing at 65%. And you're saying that from 65%, they're going to slow down to 11%? Yeah, it's possible, all right? So let's put that in, right? As a valuer, as an analyst, you have to always have, the worst case scenarios, right? So let's put in 11.7% as our growth assumption. And let's assume that after 5 years, that will halve to 5.85% and then slow down to 4%. So with this assumption, the intrinsic value becomes $293, which means at the share price after hours of $250, it's still selling at a 15% discount. So when you value a stock, it's never one number. It's always a range because there's always a difference in your expectations, a growth estimate. So the range of FB, I would say, is pessimistically worth 293 to expected worth about $400. So if this is the range of the valuation, and right now FB is selling at 250, is it a good deal? It's not a bad deal, right? So you're buying it undervalued. And when you buy a great business undervalued, you can't really go wrong. Now, not to say that the share price can't keep going down in the short term. It could still go lower because in the short term, prices are driven by emotions and manipulation. It may still go down in the short term. But over time, you will make money because you're buying something at less than what it's really worth. All right. Now, finally, before I make a decision, I like to look at the charts to look at technical patterns. So if you look at the charts of FB, again, I mentioned this earlier. You can see there's a support level at 291, another support here at 253, and a final support level here at 231. So if the price opens today at about 260, it's at a reasonable level to add shares, okay? Now, if it breaks this level, then the next level of support will be 231. So when should you start buying? It really depends on how many shares you already have or whether you have any shares at all. Okay, I already have FB shares. I've been holding FB for many, many years. My cost is very, very low. And I already have a pretty big position. So to me, I've got about 4.5% position in FB. So a 4.5% position to me is almost a full position, right? So for me, I'll only add if it gets to $230, which is the last support level. All right, so that's my analysis of FB moving forward. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.